The dollar is collapsing, and nobody is telling you why. Down 9% in 2025, the worst start to a year since 1973. The same year, America abandoned the gold standard. History doesn't repeat, but it rhymes, and right now, it's screaming. This isn't market volatility. This isn't a correction. Analysts suggest this is the opening move in the most aggressive monetary restructuring since Franklin Roosevelt confiscated gold in 1933. The pattern is there if you know where to look. The pressure on the Federal Reserve, the attacks on Jerome Powell, the whispers about gold revaluation, the $38 trillion debt hanging over everything like a guillotine. And at the center of it all, a plan that most people don't even know exists. They're calling it the Mar-a-Lago Accord, a blueprint for devaluing the dollar while somehow keeping its reserve currency status. It sounds impossible because it nearly is. But history shows that when debt reaches critical mass, governments don't ask permission. They reset the board. They change the rules. They make the impossible mandatory. Here's what you need to understand. The dollar's strength has become America's weakness. Sounds backwards, but stay with this. When your currency is too strong, your exports become expensive. Other countries can't afford your goods. Your factories close, your manufacturing base hollows out. Meanwhile, imports flood in cheap. The trade deficit explodes. You're bleeding jobs and industries while the rest of the world gets rich selling to you. For decades, economists explained this away as the price of being the reserve currency. The trifine dilemma, they called it. America had to run deficits to supply the world with dollars. It was our burden, our responsibility, the cost of global leadership. But many policy insiders now argue that this arrangement has become a wealth extraction mechanism. America provides the currency stability. America provides the military umbrella. America absorbs the trade imbalances. And what do we get in return? Debt, deindustrialization, dependence on foreign manufacturing for everything from pharmaceuticals to microchips. Now look at who's in power. Look at their background. Look at their statements. Trump has been consistent on this for 40 years. The dollar is too strong. Trade deficits are killing us. Other countries are taking advantage. He said it in the 1980s. He said it in 2016. He's saying it now. And this time he has the advisors and the political capital to actually do something about it. Enter Stephen Moran, chair of the Council of Economic Advisors, former hedge fund strategist, the architect of what insiders are calling Trump's monetary reset. Before joining the administration, Moran published a paper that reads like a manual for economic warfare, a user's guide to restructuring the global trading system. The title alone tells you everything. This isn't about tweaking policy. This is about restructuring, about tearing down the current system and building something new. The thesis is simple but radical. The dollar is overvalued because the world demands it as a reserve asset. Foreign governments buy treasury bonds, not because they're great investments, but because they need dollars for trade and reserves. This artificial demand keeps the dollar high, too high. High enough to strangle American manufacturing. The solution, according to this framework, is to make the dollar less attractive, to reduce that artificial demand, to let the currency fall to what Moran calls its fair value. But here's the problem. You can't just announce you're devaluing your currency. Markets would panic. Capital would flee. Interest rates would spike. The debt would become unpayable. You need leverage. You need pressure points. You need other countries to cooperate or at least not resist too aggressively. This is where the strategy gets interesting and dangerous. First, tariffs. Trump announced reciprocal tariffs in April 2025. Massive, disruptive, designed to hurt. Many economists initially dismissed them as trade policy, but strategic analysis suggests they might be leverage for something bigger. Tariffs give you negotiating power. They give you something to offer in exchange. Lower your currency's value against the dollar and we'll reduce your tariffs. That's the carrot. The stick is darker. The stick is the American security umbrella. Since World War II, the United States has guaranteed the defense of dozens of countries. NATO, Japan, South Korea, the entire liberal international order rests on American military power. That protection has always been seen as a public good, something America provides because it serves our interests and values. But Moran's framework reframes it as a commodity, a service that should be paid for. And if you're a country that wants to keep that protection, you might need to help America with its currency problem. This is where the Mar-a-Lago Accord comes in. The name deliberately echoes the Plaza Accord of 1985. Back then, the Reagan administration convinced France, West Germany, Japan, and Britain to jointly intervene and weaken the dollar. It worked. The dollar fell 30% in 2 years. American manufacturing got more competitive. The trade deficit shrank. Reagan called it a success, but there were consequences. Japan's currency appreciated so much, it triggered an asset bubble. When that bubble burst, Japan entered decades of stagnation. They're still recovering. The Trump administration's version would be more aggressive. According to Moran's framework, the goal is coordinated currency appreciation among America's trading partners. China, the European Union, Japan, the big surplus countries. They would sell dollars. They would buy their own currencies or other assets. They would agree to hold longer-term treasury bonds instead of short-term bills, reducing their flexibility to exit quickly. In exchange, they'd get tariff reductions. They'd keep their access to American markets. They'd maintain the security guarantees they depend on. If that sounds coercive, that's because it is. And if other countries refuse to cooperate, Moran's paper outlines unilateral options. This is where it gets truly radical. The United States could impose what he calls a user fee on foreign holdings of Treasury securities, essentially a tax on the interest payments. Economists have another word for this: default. Selective default, maybe, but default nonetheless. You hold American debt. We're going to withhold part of what we owe you. The rationale is that foreign reserve holders are supposedly price insensitive. They need dollars regardless of the return, so America can extract value without losing buyers. Legal experts point out this would require invoking the International Emergency Economic Powers Act, the same authority used for sanctions on enemy nations. Using it against allies and trading partners would be unprecedented. It would signal that the rules-based international order is dead, that American financial hegemony now operates on pure power rather than mutual benefit. But here's what makes this more than just theory. The pieces are moving into position. Trump has repeatedly attacked Jerome Powell, called him a nut, said he wants him gone. Demanded interest rate cuts of 3 full percentage points. Powell has refused, citing inflation concerns from the tariffs. The tension is extreme, and it matters because any currency devaluation strategy requires Federal Reserve cooperation. You can't coordinate a Plaza Accord-style intervention if your central bank is fighting you. History provides the template. In 1985, Fed Chair Paul Volcker worked closely with Treasury Secretary James Baker. Volcker cut interest rates from 12% to 6% over 2 years. Those rate cuts were essential. They helped the dollar fall. Without Fed cooperation, the Plaza Accord would have failed. Trump knows this. He studied the Reagan playbook. He owned the Plaza Hotel when that deal was signed. Now he wants his own accord, his own monetary reset, and he needs a compliant Fed to make it happen. This is why the pressure on Powell matters. This is why Trump keeps threatening to fire him, even though the law supposedly protects Powell until his term ends in May 2026. Trump is testing the boundaries. He's already fired other supposedly protected officials. He's challenging precedents that stood for decades. Legal scholars debate whether a president can remove a Fed chair for policy disagreements. Trump seems willing to find out. And then there's Stephen Moran's appointment to the Federal Reserve Board of Governors. This happened after another governor surprisingly resigned. Moran now has a permanent vote on the Federal Open Market Committee. He sits inside the institution that sets monetary policy. The architect of the Mar-a-Lago Accord now has direct influence over interest rates, money supply, and the Fed's balance sheet. Some analysts argue this ensures coordination between the White House economic strategy and the central bank that has to execute it. The parallel to 1985 is striking. You need Treasury and the Fed working together. You need leverage over trading partners. You need a crisis atmosphere that makes dramatic action seem necessary. You need political will to override objections. Check, 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 check. Now add the gold piece. This is where the strategy goes from aggressive to potentially catastrophic or revolutionary depending on your perspective. The United States holds 8,133 metric tons of gold, the largest official stockpile in the world. But on the Treasury's books, that gold is still valued at $42.22 per ounce. That price was set in 1973. Gold currently trades around $3,000 per ounce. The gap is staggering. If the Treasury revalued that gold to market prices, it would instantly create over $770 billion in liquidity. Money that doesn't require borrowing, money that doesn't add to the debt, money that appears on the balance sheet like magic. For every $4,000 increase in the gold price, the government could generate another $1 trillion. Economists describe this as monetizing assets that are currently being carried at Depression-era valuations. Roosevelt did exactly this in 1934. The government valued gold at $20 per ounce. Roosevelt revalued it to $35, a 70% increase overnight. The Treasury's gold certificates jumped in value by billions. That money helped fund New Deal programs. It helped stabilize the banking system. It helped end the deflation that was strangling the economy. The mechanism was simple. The Treasury issued new gold certificates to the Federal Reserve at the higher price. The Fed credited the Treasury's account, instant liquidity. Trump administration officials have indicated interest in this approach. Treasury Secretary Scott Bessent has discussed examining America's gold reserves. There's been talk of an audit of Fort Knox. The last comprehensive audit was in 1953, 70 years ago. Some analysts suspect the groundwork is being laid. The legal framework exists. The Federal Reserve updated its accounting manual in May 2025 to clarify procedures for gold certificate monetization. The Secretary of the Treasury has the authority. Congress doesn't need to approve the initial revaluation, though using the funds would require legislative action. But here's where it gets complex. Revaluing gold sends a signal. It says tangible assets matter more than paper promises. It says the government is preparing for monetary instability. It says confidence in pure fiat currency is wavering. Markets would react. Gold prices would probably surge as investors front-run the official revaluation. Other countries might accelerate their own gold accumulation. Central banks around the world are already buying gold at the fastest pace in decades. Poland added 60 tons in 2025. China has been steadily building reserves. If America signals it's moving back toward some form of gold backing, the scramble would intensify. Some economists go further. They argue revaluation could be the first step toward gold-backed Treasury securities. Not a full gold standard, but something in between. Bonds that are redeemable in physical gold at a fixed rate. Zero-coupon bonds where the return comes from gold price appreciation rather than interest payments. This would dramatically reduce the government's borrowing costs. Right now, interest on the debt exceeds defense spending. It's becoming the largest single budget item. Gold-backed bonds could change that equation. Critics call this financial alchemy. They say you can't create real value by changing numbers on a ledger. But defenders point to history. Roosevelt's gold revaluation worked. It helped end the Depression. The Plaza Accord worked. It reduced trade deficits and gave American manufacturing breathing room. Why wouldn't a modern version work now? The counterargument is that the world has changed. In 1934 and 1985, most currencies were still managed by central banks. Capital controls were normal. Financial markets were smaller. Today, trillions of dollars move across borders instantly. Private investors hold massive positions. You can't just order them to cooperate. More importantly, the countries America needs to pressure are different now. In 1985, the Plaza Accord targeted allies, Japan, Germany, France, Britain, countries that depended on American protection. Countries that shared strategic interests. Today, America's largest trade deficits are with China. China doesn't depend on American security guarantees. China is a strategic competitor. Getting Beijing to cooperate in devaluing its currency makes no sense from their perspective. Why would they help America become more competitive? This is the fundamental tension. The Mar-a-Lago Accord strategy assumes leverage that may not exist. It assumes other countries will accept a weaker dollar because they need American markets and protection. But China has been preparing for exactly this scenario for years. Belt and Road Initiative, development of alternative payment systems, accumulation of gold reserves, expansion of renminbi usage in trade. Beijing has been building redundancy into the global system specifically, so they're not vulnerable to American pressure. Europe is different but also problematic. The European Union might cooperate on currency coordination, but Europe is dealing with its own economic challenges. Slow growth, aging demographics, energy costs, political fragmentation. Asking European countries to appreciate their currencies would make their exports less competitive. It would slow their already sluggish economies. German manufacturers wouldn't accept that willingly. The political cost might be too high for European leaders. Japan is the most likely partner. They hit it before, they have security dependence on America, they fear China. But Japan also remembers what happened last time. The Plaza Accord triggered the bubble economy, the collapse, the lost decades. Japanese policymakers are deeply skeptical of coordinated currency interventions. They've spent 30 years trying to recover from the last one. So what happens if the multilateral approach fails? What if other countries refuse to cooperate? This is where Miran's unilateral options come in. And this is where the strategy becomes genuinely dangerous. The user fee on treasury holdings, the threats to withdraw security guarantees, the use of emergency economic powers against allies. These are not the tools of a confident hegemon. These are the tools of a declining power trying to arrest its fall through coercion. And there's a deeper problem. The strategy assumes America can have it both ways. Weaken the dollar, but keep reserve currency status. Reduce foreign holdings of treasuries, but maintain low borrowing costs. Pursue economic nationalism, but preserve global leadership. These goals may be incompatible. The dollar's reserve status isn't just about economic convenience. It's about trust, about the rule of law, about the belief that American institutions are stable and predictable. When you start threatening selective defaults, when you pressure central banks, when you weaponize security relationships, you erode that trust. Multiple economists have pointed out the contradiction. You want the world to keep buying your debt, but you're threatening to withhold interest payments. You want to maintain the dollar's safe haven status, but you're deliberately trying to weaken it. You want other countries to hold long-term bonds, but you're creating uncertainty about whether you'll honor them. This is asking for reserve currency privilege while undermining the foundations that support it. Market reaction tells the story. The dollar is down 9% in 2020. Foreign investors are selling treasury bonds. Gold hit record highs above $3,400 per ounce, the longest winning streak since 2020. Capital is fleeing to safety, but that safety increasingly isn't dollar-denominated. The euro is stronger against the dollar than at any point since 2021. This is happening despite Europe's economic problems. That tells you something about dollar confidence. The yield curve is sending warnings. Long-term treasury yields are rising despite Fed policy. That means investors are demanding higher returns to hold American debt. They're pricing in risk, inflation risk from tariffs, default risk from talk of user fees, political risk from attacks on Fed independence, currency risk from deliberate devaluation. None of this is compatible with reserve currency status. Business leaders are expressing concern. Multiple CEOs have warned about the economic impact. Investment decisions are being delayed. Companies are moving supply chains. The uncertainty alone is costly. Markets hate unpredictability. They hate regime change. They hate situations where the rules might change overnight based on political decisions. All of that is happening now. Even some Trump advisors seem worried. Treasury Secretary Bessent has reportedly warned White House officials that firing Powell would destabilize markets. That suggests there's internal recognition of the risks. But it's unclear whether that caution will prevail. Trump's pattern has been to double down when challenged, to escalate when conventional wisdom says to back off, to treat economic relationships as zero-sum battles where intimidation and unpredictability are advantages. The geopolitical implications are staggering. If America succeeds in this strategy, if the Mar-a-Lago Accord becomes reality, it would represent the biggest shift in global monetary arrangements since Bretton Woods. The rules that have governed international finance for 50 years would be dead. Every country would need to recalculate its relationship with the dollar. Every central bank would need to reconsider its reserve composition. Every business would need to hedge currency risk differently. If it fails, the consequences might be worse. A failed attempt at coordinated devaluation could trigger the exact dollar crisis America is trying to avoid. Foreign holders could dump treasuries. The dollar could go into freefall. Interest rates could spike. The debt could become unsustainable. America could face a choice between default and hyperinflation. Either option would end dollar hegemony not through careful management, but through catastrophic failure. Some analysts argue we're watching the end of the American century in real time, that this isn't a reset, but a collapse. that Trump is accelerating American decline by undermining the very institutions that made American power possible: the Federal Reserve, the Treasury bond market, the rule of law, the alliance system. Every piece of the architecture that supported dollar dominance is being stress-tested to destruction. Others take a different view. They argue Trump understands something the establishment refuses to admit: that the current system is already failing, that the debt is already unsustainable, that dollar dominance has become a trap rather than an advantage, that the choice isn't between stability and disruption. It's between managed disruption now or catastrophic collapse later. In this reading, the Mar-a-Lago Accord is a desperate but rational attempt to reshape the system before it breaks completely. Consider the numbers: $38 trillion in debt, annual deficits over $2 trillion, interest payments that exceed defense spending, a trade deficit over $1 trillion per year, a manufacturing base that's been hollowed out for decades. These are not problems that can be solved with conventional policy. Tax increases won't fix it. Spending cuts won't fix it. Monetary policy alone won't fix it. The scale of the imbalances requires structural change, and structural change means someone loses. That's the part nobody wants to say out loud. Currency devaluation helps debtors and hurts creditors. It helps exporters and hurts importers. It helps workers in manufacturing and hurts consumers buying imported goods. It helps the government service its debt and hurts foreign governments holding treasury bonds. There is no version of this where everyone wins. The question is whether America has the power to impose those losses on others, whether we can force trading partners to accept a weaker dollar, whether we can maintain reserve currency status while deliberately devaluing, whether we can threaten allies without losing them, whether we can pressure the Fed without breaking it, whether we can revalue gold without triggering a monetary crisis. These are not questions with clear answers. What we do know is that the pieces are in motion. The tariffs are real. The pressure on Powell is real. The dollar's decline is real. The gold accumulation by central banks is real. Moran's appointment to the Fed is real. The updated procedures for gold certificate monetization are real. The discussions about Treasury reform are real. This isn't speculation about what might happen. It's documentation of what is happening. History suggests that when governments face debt crises, they choose inflation and devaluation over default and austerity. It's politically easier. It's economically faster. It spreads the pain across the entire population rather than concentrating it on specific groups. Roosevelt did it. Nixon did it. Every government with the power to print money eventually uses it to escape debt burdens. The difference now is that the dollar isn't just America's currency, it's the world's currency. 70% of global trade is invoiced in dollars. 60% of foreign exchange reserves are in dollars. The entire international financial system runs on dollar infrastructure. When you devalue the world's reserve currency, you're not just changing one price, you're recalibrating every price, every contract, every balance sheet globally, and you're doing it in an environment that's already unstable. War in Ukraine, tensions with China, climate pressures, demographic shifts, political polarization, supply chain vulnerabilities, technological disruption. The world is not in a position to absorb a major monetary shock without cascading consequences. So what happens next? Multiple scenarios are possible. The optimistic case is that Trump's team executes a carefully managed devaluation. Other countries cooperate enough to prevent chaos. The dollar falls 20 to 30% over 2 years. American manufacturing becomes more competitive. The trade deficit shrinks. The debt becomes more manageable through inflation and growth. Reserve currency status is maintained because there's no viable alternative. This would be painful, but survivable. Something like the Plaza Accord, but on steroids. The pessimistic case is that the strategy fails. Other countries refuse to cooperate. Markets panic. Foreign investors dump treasury bonds. The dollar crashes rather than falling in an orderly way. Interest rates spike. The government faces a funding crisis. The Fed loses independence and credibility. Inflation explodes. Reserve currency status evaporates. America experiences what economists call a sudden stop. Capital flight, credit crunch, deep recession. This would be catastrophic, not just for America, but globally. The middle case is messy and drawn out. Partial cooperation, partial success, years of elevated uncertainty, gradual erosion of dollar dominance, gradual rise of alternatives. The monetary system fragments into regional blocks. China's renminbi for Asia, the euro for Europe, the dollar for the Americas, digital currencies and gold playing larger roles. This wouldn't be a single dramatic event. It would be a grinding transition over a decade or more. Which scenario we get depends on decisions being made right now, behind closed doors. In the White House, at the Federal Reserve, in finance ministries around the world, the public debate is still focused on tariffs and trade wars. But the real battle is over monetary architecture, over who controls the rules, over who bears the costs of adjustment. Trump's shadow dollar plan is the most audacious economic gambit in generations. It's a bet that America still has enough power to rewrite the rules in its favor. That the dollar's network effects are so strong that it can survive deliberate weakening, that other countries will accept losses, rather than risk American retaliation. That gold and intimidation can substitute for the trust and stability that made the dollar dominant in the first place. Maybe that bet pays off. Maybe Trump pulls off what would be remembered as a masterful economic repositioning. A successful managed decline that preserves American power for another generation. Or maybe we're watching the end of an era. The moment when American overreach finally exceeded American capacity. The moment when the rest of the world decided they'd had enough. Either way, this is the story, not the daily drama, not the tweets and the provocations. This, the systematic pressure on every institution that supports dollar hegemony. The revival of Depression-era playbook, the weaponization of economic relationships, the blurring of money and power to the point where they're indistinguishable. This is what historians will study. This is what determined the trajectory of the 21st century. The pattern is clear for those willing to see it. Debt crisis, currency overvaluation, political will for dramatic action, historical precedents for gold revaluation and forced devaluation, pressure on central bank independence, coercion of trading partners, all the pieces of a monetary reset. Not speculation, not conspiracy, just pattern recognition. And if current trends continue, we're watching the early stages of the biggest financial restructuring since the gold window closed in 1971. The only question left is whether this ends with American renewal or American decline, whether Trump's shadow dollar plan saves the empire or breaks it. And we won't know the answer until it's too late to change course.